Welcome back to the program. Well, we are approaching the top of the hour, but we just can't stop talking about this inflation read that we are expecting out in the United States. Let's welcome into the program Dave Flanagan. He's joining us from Curve Securities. And also my guest host, obviously, Ben Clark from TMS Capital and John Noonan from Thomson Reuters. Welcome, though, Dave. Great to have you here.
Thanks, Megan.
We were talking in the break about all the hype around this inflation read, which is not misplaced considering the volatility that we saw over the past week or so. However, you raised a good point. This is not even the Fed's preferred measure of inflation, which is, of course, the PCE deflator. So, much ado about nothing, or would that be just too much of a complacent view to take at this stage of the game?
Not nothing to do about nothing, obviously. The wages data last week obviously caught people by surprise. But when you look at historically context, the 2.9% annual read we got on wages was only 0.1 above where it was in September last year. And if you look through the volatility in the last four reads, the average of those last four reads in the last 4 months of last year was only the same as what we saw across the entire year. So wages hasn't got running. I think what the wages data did was add to the narrative that we'd already seen about the bond market. So from the middle of December, we'd seen bonds start to rise on the tax deal that the administration had come out with, and that sort of gathered speed as now we look at the twin deficits and how they're going to fund that. I think the wages story just added into that, and that's probably what got the market a little bit skittish. That, hang on, we've already got a few things to worry about, and now the wages data has become an issue. So all of a sudden everyone's gone, okay, what's the next big thing? It's CPI next week, so everyone's all of a sudden got all wound up about it. And as you mentioned, when we get to it, it's actually the PCE they're going to be looking at anyway. So I think there could be a binary outcome tonight in the short term. It could be a big thing for markets over tonight and maybe tomorrow, but come next week it may not be an issue.
And we also get retail sales tonight. So if we move past this, what is the next big event that we're looking for in the U.S. that will help form our view and shape our view of what we will expect the U.S. Fed to do? Because pretty much the market's priced in. I mean, everybody says that March is a done deal.
Mm-hmm. Well, I think the incoming Chairman Powell said it last night. They're still continuing on. So unless we get some data shock or anything like that in the near term, I think the dot plot is where we need to head. We've got to assume that at least 3 are coming, and there's a chance of another one if things get away from them. So.
Yeah, Dave, the bearishness in the bond market right now, I haven't seen, well, we've had decades of a bull run. Is this just the end of a cycle that we're seeing? I mean, a lot of, Bill Gross, formerly of PIMCO, now at Janus, a few of the others, Jeffrey Gundlach, they're saying this is the end of the bull market in bonds. So everybody seems to be on that consensus that U.S. 10-year yields, for instance, are going to be 3% or higher. And I saw in the Bank of America survey today, that was released today, 69% of investors are underweight bonds, the highest since they've been taking the survey. Is this getting a little bit overdone? Is this hype a little bit too much right now? And is there still good value in bonds for the selective player?
In answering the first question there, from a technical point of view, it does look like the bull market is over. If you draw a trend line going back 30 years, we've seen a break, and that's held at a monthly close point as well. So it does certainly look like, from a technical point of view, we have seen the end of that run. In the short term, we do actually have speculative positions short on US 10s that are at the highest level they've been since Trump was elected back in 2016. So there is actually the risk that we do get a rally depending on how the number unfolds. But I think over the longer run, you do have to look at the fundamentals. You look at the supply and demand of what's going on. And I was looking at some data points the other day, and the funding task that the US Treasury is going to have is exploded from last year. So their funding task last year was around $515 billion, and it's expected to be about $955 this year. So they've got an extra $500 billion they have to fund. And then you've got the Fed who's backing away at the same time to the tune of about $400 million, and that's in their total assets. A lot of that's not all bonds. And then another 600 plus the year after. And so you just look at the supply and demand fundamentals there, suggest that prices and yields have to rise. And so I think that's where the long-term trend is heading, but it's not going to be a linear outcome. I think we're going to have a bit of volatility even in the bond market along the way.
And as long as it's orderly, as long as it's an orderly rise and we don't get any shocks in the bond market, like a bond market crash, it's because it is priced in, it probably shouldn't create too much of a tremor in other markets, should it?
A big move obviously will cause more volatility, but if we do get an orderly move and we get to say 3%, 3.14, which is kind of some of the technical indicators we're looking at, if we do have a pause there and then another move, that'll soften things. But if we get a move to, 314, 335, all of a sudden, that's some big capital losses that those holders will be having if they're trading. So that could definitely cause some concern.
Now, just to switch from that briefly, I know that one of your colleagues, actually, who introduced us, Greg McKenna at AxiTrader, always says that the NAB Business Survey is his favorite release of the month. Do you like it as much as he does? Yesterday, coming in quite favorably. Today, I was just speaking with NAB's chief economist, Alan Oster, and they're still sticking by their forecast for 2 interest rate hikes in 2018. Now, obviously, that comes with caveats, and they're watching the wages story here really importantly. But what was your overriding sense coming through from that business survey yesterday?
Well, if you look at the headline indexes on both business confidence and conditions, they're both really high, and it does bode well, and it looks like it is quite positive. The one thing Alan Oster said in his release was he did highlight that 2 critical components of that in the sub-indices by industry were actually quite weak. Like retail sales has been very weak for some time, but recreational and personal services is also now at a 3-year low. I think that speaks volumes to where the consumer is at, and the consumer still makes up around 2/3 of the economy. And so even if we've got booming business sector, if that's not flowing through to wages, and then it's nothing really to get too excited about just yet.
And as far as the RBA is concerned too, they're worried about household debt, how that's going to affect consumer spending, and the fact that wages aren't rising to compensate for the household debt. Even with the boom time that we're seeing in business confidence, doesn't really mean that they're going to be jumping off the seats to raise rates either, does it?
Correct. And then the question is, when wages, we do see wage rises coming. If you look at where the underemployment ratio is, and it tracks nicely with the wage cost index, we do see a slight uptick in wages coming over the next 6 months. The question is, when consumers finally get wage growth after such a period with none or very little, do they actually spend it? Or do they try and repair that household balance sheet, pay down a bit more debt before they actually loosen the purse string? So that'll be the interesting dynamic that plays out over the next 6 to 9 months.
Yeah, we didn't even get a chance to talk about the unemployment data tomorrow, really overshadowed by this US inflation read coming through tonight. Dave Flanagan, thank you so much for joining us. Curve Securities, John Noonan, Thomson Reuters, thank you. Ben Clark is sticking around. We'll talk more about reporting season, the day's company reports after this short break. The final count is next.